The integration of European financial markets. The integration of these financial markets improves the overall productivity of the European economy. Capital markets' role is to collect savings and to provide producers with the financial means that they need to invest in productive equipment and new operations. It's a market for securities and includes stock and bond markets. It transforms maturity. It performs intermediation. And it also deals with inherent risk. The financial markets make savers and borrowers meet, and it offers each saver and each borrower the best possible deal.
How the financial markets work. Traditionally, a market is a place where people go to buy or sell things to meet their needs. Financial markets are very similar. They allow people to buy and sell various financial products, such as stocks, bonds, and currencies. Many organizations rely on financial trading to meet their business needs, while there are others and individual people who trade the markets to profit from price fluctuations. This is either in the short term or the long term. Take Mrs. Miggins, for instance, who thinks the price of gold might go up in the future. She decides to buy some and sells it a month later when the price goes up, making a profit. Of course, the price could have gone down, and that was the risk she was willing to take. Market prices go up and down on a daily basis according to supply and demand, and they are affected by a number of factors which we will look at later. First, let's take a look at some of the most familiar financial markets in the world, those that deal in stocks, currencies, commodities, and bonds. The stock markets. The basic purpose of a stock market is to enable companies to raise money by selling shares in their ownership. A share, also known as stock or equity, is therefore a small piece of ownership in a company. The price of a share generally reflects what people think the prospects of a company are going to be in the future. Let's say the nice clothing company wants to expand its business and open more branches, but it doesn't have enough money to do this. The company could borrow money, or it could choose to give away partial exchange. The combined share prices of the largest companies listed on a certain exchange are sometimes represented by a stock index like the Dow Jones 30 or the FTSE 100. If the share prices of the big companies in an index go up, so can the value of the index itself. The currencies market, the bond markets. The bond markets allow organizations like companies or governments to borrow money by issuing bonds. A bond is basically a loan or an IOU. Someone who buys a bond from a company, for example, is essentially lending money to the company, which will eventually pay the money back with interest. The prices of bonds depend on many factors like economic data, news, sentiment, and importantly, interest rates. In fact, bond prices generally go up when interest rates go down, and vice versa. There are many people who seek to profit from changes in interest rates by trading bonds. So why do market prices go up and down? Financial market prices go up and down according to the levels of supply and the demand. Prices are constantly influenced by a number of global factors, including economics, the weather, natural disasters, wars, politics, and even simple rumors. For example, a hurricane in the US could affect the performance of a number of businesses, so people may be less interested in buying or holding on to their shares. The same hurricane could cause problems in exporting goods to other countries, and so the currencies market could be affected. Even the bond markets could be affected if the hurricane damage caused changes the outlook for the economy. Markets can be exciting and sometimes unpredictable. A good way to learn more about how different markets work is to use systems that let you practice trading without risking your own money. These will help you build your knowledge and experience of how market prices change and help you feel more comfortable about the risks.
In short, financial markets allow people to buy and sell financial securities like stocks and bonds, commodities and items of value. The best-known financial institutions are banks. Banks borrow from their customers by receiving deposits, and they offer loans and even provide assistance for managing portfolios. Money is one type of assets. Asset is a resource having economic value that an individual, corporation, or country owns or controls with the expectation that it will provide future benefit. One can choose term deposits for there is a high interest which grows with the maturity. Because the bank will re-lend the deposit to another customer who will be ready to pay a higher interest for loans or longer maturity, bank deposits are not the way to save. You could buy bonds or stocks. Savers often don't like to part with their money, and borrowers prefer to obtain stable resources. The markets mostly borrow short and lend long. Savers and borrowers do not usually meet face to face. Savers deposit their funds in financial institutions such as banks that re-lend them to borrowers. If the interest rate of borrowing is too high, this would discourage low-risk borrowers, while desperate borrowers are willing to pay any premium. Bonds and shares are risky. If the issuer gets bankrupt, they are probably worth nothing. This is risky, for a loan implies giving out money against the promise of future payment. The borrower may face difficulties that sometimes make repayments impossible. The investment banks manage portfolios. Insurance companies are also financial institutions. They take deposits by their customers and use this to make loans as they invest in financial assets.
Diversification is a risk management technique that mixes a wider variety of investments with a portfolio in order to yield higher returns and to lower risk. Diversification minimizes the risk from any